Be Wealthy and Smart, episode 1186.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about wealth building with private equity. And on this show, I interview Joe Endoso, who is Chief Operating Officer of Linqto, a private equity firm whose investments I've invested in, including Ripple stock, which you've probably heard me talk about. And I wanted to do this show because this is the 9th anniversary of Be Wealthy and Smart. Yes, it was 9 years ago that I actually started the podcast, and now with over 1,100 episodes, topical news, the latest, the most current information that can help you with your investments so you don't have to go searching for it all over the place. It's delivered right to you. On my anniversary shows, I try to bring you even more value, really exceptional speakers or topics or information that can help you with your investments. Now, private equity is a little bit of a different animal because there is a requirement that you are an accredited investor. That means you have to have either certain net worth or income requirements, and there are a few other ways to qualify, and all of that is spelled out on a podcast that I did. So if you want to know all the ways to become accredited and be able to invest in private equity, check out podcast 1029, and I go through all the details there. But whether you are an accredited investor or aren't an accredited investor, I think this is a really important podcast that you can learn so much from. If you aren't yet accredited, then you'll want to learn because you want to study places where affluent people invest before you make your wealth so that you are more knowledgeable, up to speed, and know what kind of opportunities are available to you. And if you are an accredited investor, then you want to hear about the investment opportunities that Joe talks about. Some very specific technologies that are exciting right now, like artificial intelligence, AI, blockchain investments, and lots of exciting technologies. And if you decide that you do want to invest in private equity, there's a link in the show notes for you to do just that. Thank you so much for 9 years of Be Wealthy and Smart, whether this is your first episode you're listening to or whether you've been here from the beginning or found me somewhere in between. I wouldn't be here if it weren't for you. So thank you so much for listening, for reviewing the podcast, and all of the positive feedback that encouraged me from the start to do this podcast, to make it something that were bite-sized pieces in everyday English for anyone to understand and take some of the complexity out of investing. Private equity is one of my favorite investments right now. I think the opportunities are incredible, and the bear market last year really gave us more time to invest in companies that will be going public, possibly later this year or into next year. To me, it's only made those opportunities even better. But I'll let you listen to what Joe has to say and see what you think for yourself. Here we go. Hey, Joe, it's so great to have you on the show today. Thank you for being here.
Thank you so much for having me on, Linda. It's always a great privilege.
Well, it's an honor to have you. I really respect you, and as Chief Operating Officer of Linqto, you are amazing, knowledgeable, have an incredible background as an investment banker and other experience. So I want to really delve into what you know about private equity investing and about the venture capital industry, really what's going on out there in a way that gives us a broad brush of what's happening, but then also maybe drilling down on some of the companies within Linqto that people might want to invest in. How does that sound? So we've been through we've been through a bear market in the stock market, but how did that impact the venture capital and private equity market last year?
It's definitely been impacted, albeit on a delayed basis, Linda. So historically, the private markets will correlate, but with a lag to the public markets. And that lag is typically 6 months, which is more or less what we what we saw this time around, right? So the private markets started dipping down, and there's a number of ways we are able to measure this, but started dipping down, call it the fourth quarter of 2021. And then that significantly accelerated in the middle of the year. So quarter two, quarter three of last year was when we saw a significant deepening of the market into bear territory, and that trend continues today. So how is that reflected? It's reflected in the fact that valuations have declined significantly. So you're seeing that in the secondary trading. So shares that already have been issued and are being held, but then resold amongst different parties. And we are an active part of that secondary market at Linqto. Those shares today for the same company are going to be selling at a discount to what they were selling for same time last year, right? So no different than that kind of situation for a public company in the public market. Companies that are raising primary capital, meaning issuing new shares in the private market today, are doing it at lower valuations than they were doing same time last year. Again, that's the same thing. If you were in the public market in a public company doing a follow-on offering, you'd probably get a much lower valuation today because your stock price is a lot lower than you did a year ago.
So when you talk about valuation, you're talking about market valuation. You talk about investing in unicorns, which are worth $1 billion. So some of those have dropped below $1 billion valuation, is what you're saying. And so their stock price has been discounted and is now selling below where it used to sell because the company's now worth less than it was prior to the bear market starting.
Correct.
Yeah.
And like in the public markets, right, you have to be very, very discerning about those kinds of declines, because in some cases it's the result of what I call dislocated markets and just liquidity, right? Meaning that when you're in a bull market and you have lots of money chasing the same stock, that has an upward effect on the price of that stock. And that liquidity effect may actually have nothing to do with the fundamentals of the company improving. So think about it in terms of a PE ratio, right? That that PE ratio can improve either because the P goes up or the E, right, goes up.
Earnings, yeah.
And in this instance, if you don't have earnings that are driving it, but simply the fact that the price is being moved up by excess liquidity, you may have the impression that a company has gotten more valuable, but that doesn't necessarily mean it's intrinsically more valuable. It just means that the stock price has gotten bid up. So that phenomenon is no different in the private market. Right, we'll go through cycles where private company stock gets bid up, and it may or may not have anything to do with the company actually improving its fundamentals. On the downside, it's the opposite. Just because a company's, or it's the same analogy, right? Meaning if a company's stock price gets bid down, it may be because the company's economic prospects have deteriorated, but it may simply also be that liquidity has gotten sucked out of that particular stock in the market generally, and so the price is down. Today in the private markets, we have a ratio of roughly 2 to 1 between the sell side and the buy side in terms of liquidity. That's a significant market dislocation, right?
So what does that mean, Joe? That you have a
What that basically means is that on any given day, there's roughly 2 sellers for every 1 buyer in terms of dollar volume for any given stock in the private market in the secondary. That's a huge dislocation, right? So buyers like us have a significant amount of market power right now, and that actually is good. It's in bear markets that you make money by investing cheap. And we have right now a tremendous opportunity because of the prices are down. We have a lot of market power. We can continue to drive price down. We have a lot of negotiating power in these transactions. And as a result, we and our clients can benefit. from significantly lower entry prices, as long as you pick the right companies. And that goes back to the thing about making sure that the company's price is lower because of the market liquidity rather than because the company actually is worse today than it was a year ago.
Right. So for people who aren't that familiar with private equity, what you're saying is that you actually buy stock from employees of companies that are still private, and the price that you can buy that stock from them has actually gone down in the last year since this bear market. So now you're able to get it at a better price and pass it along to Linqto investors who want to invest in that company. Is that right?
That's correct. And the perfect situation is where a company actually has improved its economic performance in that period of time we're talking about, even though their price has gotten driven down, right? So that's a perfect situation if you're a savvy investor to take advantage of. And we're trying to do exactly that, Linda. Buy cheaper stock of companies who actually have improved, right?
I can think of one in particular that I like that's happened to. Yeah.
Well, yeah, exactly. Because that's been driven down not just by market forces, but by externalities, right? That have nothing to do with the market, have everything to do with regulation and the law.
Yes. And a lawsuit. Yes.
Correct. And we're talking about Ripple, right? Which is one of our large holdings. And as you know well, and this, maybe can segue into a discussion about, how we make our investments and the process of selecting them, Linda. But because our business model is predicated on Linqto using its own capital, its own balance sheet, and putting that capital at risk, right, by making investment selection and closing investments and holding stock before we bring our customers into them and ask them to participate, right? We're always at risk. On every single name on the platform, we're at risk.
That's right.
And that's why investment selection is so important.
So how do you decide on new companies that you want to bring onto the platform?
It's a multi-step process, right? And it starts at a macro level. It's what I call sector selection first, right? And what that's fundamentally about is because we're making investments in technology in that space. And the reason for that, by the way, is because if you look at the S&P 500 or any market index in the public market, you will see that in the last 30 years, technology has become the dominant industry in the United States and certainly in the world. That's reflected by the fact that technology companies comprise the single largest segment of value in the equities market, right? And we don't think that's a trend that's going to reverse. So that's the reason why we're investing in private tech companies as opposed to private, grocery stores or private whatever, right?
Right.
So we start by sitting back and saying, okay, what are the foundational technology innovations that are occurring? And by that, I'm talking about forms of technology innovation that have a couple of characteristics, right? One is that they're going to lead to quantum improvements of very, very large industries that are operating in really large global markets, right? So what's an example of a foundational technology innovation? It would be something like blockchain or distributed ledger technology. It would be something like generative AI. It would be something like autonomous vehicles, right? These are all foundational technology innovations. They're going to cause many large industries around the world, when they adopt them, to significantly improve. And they will have impact because these are industries that operate in very large global markets with, billions of people as end customers ultimately, right? Examples of those industries might be finance, transportation, media and entertainment, retail, right? So we're looking at innovations that cut across large industries, and they also result in the creation of new business models, right? So examples of that would be, Ripple, right? But out in the public market, you would look at companies like Uber, Amazon, Netflix. In the private market, Linqto is a good example.
You also have drone delivery. Yeah. Yeah.
Just, drone delivery is another thing that's happening and will hugely change the whole logistics space, right? There's a company called Zipline in the private market that is doing that on a commercial basis already today in certain test markets. And all of these foundational innovations also have the advantage, and this is the reason why we invest in that they have long economic tails, meaning that the creation of value that results from these deep innovations are decades long, right? And so you have the opportunity to make an investment. So a good example of that would be Apple, right? If you think about Apple, there was once upon a time, Apple stock was available at $20 in the public market. Never mind and that's a company that today still thrives. It's loved, but its price is multiples of $20 and multiples of what you would have been able to invest in if you were a private investor in Apple, right? That's a long-tailed economic, play, and it's driven by some very foundational technology. In their case, it was basically mobile computing, right? That's what drives Apple. So we start by asking ourselves, what are these foundational technology innovations, right? And what sectors result from those? And then we look at specific companies within the sector. We say, okay, we like that sector. Let's find the companies that are going to be important, hopefully winners in those sectors. And there we do a screen that's a mixture of, fundamentals and market pricing. So on the fundamentals, it's kind of a yes/no screen. It's binary. So either a company passes the test or it doesn't. And the test has several criteria. We're looking at companies that are in the mid to late stage of private venture funding. We're looking only at companies that have revenue. We're only looking at companies that are at the stage where their product and service is already commercialized, meaning they have a demonstrable market with customers that you can actually point to. They have strong unit economics that will support profitability either currently or with a clear path in the future towards that because of those unit economics. And then, like we talked about earlier, they have a strong management team that's got the experience and the expertise to execute on that business plan, right? So either a company meets our fundamental screen, and I've shared some of the criteria, but not all. And if it does, then we look at, the price. Are we able to acquire the stock of that company at a price within the acceptable price range that we determine, right? What's the acceptable price range? How do we determine that? We look at comparable public market companies and align that with the valuation of that private company stock. We look at where we are in the market cycle to determine, is the price being affected by liquidity flows and to what extent? And is this a good time or a bad time to buy because of that? Is it overbought or oversold, right? Are we in a position of market power to negotiate the best entry price? And then we look at all of those inputs, right? We look at the company's last valuation, which is basically their book value, right? We look at the company's trading value in the market today, their fair value, and then we try to assess what its intrinsic value is based on the fundamentals. And that then allows us a range of prices that we think is acceptable to pay for that stock. So this is all done through a fairly systematic scoring system that we've developed internally. And we're able to then rate companies internally based on their attractiveness as an investment, based on those fundamentals, and based on the price dynamic, right? And then once it achieves a certain score and it's a pass, then we go out and actually try to source it. And this is the other tough part. Unlike in the public market, if I did the fundamental screen and the price screen, I would simply go on my terminal and buy it. It doesn't work that way in the private market. There's zero assured availability, right? So now, how do you buy it? Well, you have to do an outreach to VC firms. You have to do an outreach to founders. You have to do an outreach to employees. to see whether you can get the stock and at the price you want. We also have a lot of inbound solicitations. So that gives us a stream of deals to look at. We match that against what's on our target list, right? Most of the inbounds aren't on our target list. So we have to say sorry to people. We're not interested in that stock. So it's taking all of those different sources and then actually trying to make the investment.
So one of your recent additions was an AI company. And that was very interesting because it's such a hot sector right now. Tell us about your process with that company.
That was a company that we got initially through an employee that was looking to liquefy some of their vested options, right? And once we were able to gain that entry, we became a known quantity to the company because we were sitting on their cap table for a relatively small amount. And the company we're talking about is Cerebras. That's spelled Cerebras, right? We eventually were able to speak. I was able to speak to their founder and CEO, a great guy named Andrew Feldman. And out of that relationship now, we're able to get unprecedented access to their stock. The company has opened its doors and said, we like what you're doing. We trust what you're doing. Whenever we have somebody on the founding team or one of our early VCs or one of our employees want liquidity, we'll call you. And if you need more stock and we haven't called you, you call us. And, I will find somebody in the company that can sell you the shares, right? So it's a very close relationship. And Andrew, by the way, is a genius guy whom I've asked to come to a Linqto Learn session for our Team Apollo members so that you all can come in and actually meet him directly, ask questions of him directly, and learn more about what they're doing in the whole area of generative AI.
Yeah, Team Apollo members are your Linqto clients who have invested, what is it, 60,000?
It's now up going up to 80,000 because our platform gets bigger and bigger, and the Team Apollo members are basically the top 20% of our client base. So as the assets on the platform grows, the cumulative investment grows, and that, by the way, today is about 210 million, give or take. 210 million from regular people like you and me, Linda, not big institutions, right? So that hurdle to become a Team Apollo member keeps on going up.
Yeah, I'm proud to be a part of that group. It's really nice to have a little bit of extra networking. And it's really fun how you recognize people in that group. So thank you for that. And also, PolySign is a newer company that you've added and have been really excited about, which has been a good complement for a lot of people that own Ripple stock, which in many cases, I know a lot of my clients came in with a Ripple investment as their first investment, and PolySign has been a good way to diversify. How's it going with PolySign?
It's, for the last several months, probably the second most popular stock on our platform. And in some respects, I think it's because it has a lot of the same characteristics as Ripple does. So I would imagine if you're somebody that is interested and a believer in what Ripple is trying to do, you would understand what PolySign is looking to do. Both companies are operating in the digital asset space and creating infrastructure for different use cases within that space, right? So blockchain technology has uses across many industries, but one of the most important industries that it impacts is finance. A significant amount of finance is, the processing of cross-border payments that are taking place in differing currencies across national borders. That is a huge part of the international banking system. The way it's currently being done is based on technology that dates all the way back to the 70s. So it's horrendously outdated. It's super clunky, it's slow, and it's very expensive. Ripple revolutionizes that by applying blockchain technology and allowing those payments to occur very, very cheaply, instantaneously, right? And so that is a very important infrastructural play that is going to transform the nature of international payments. PolySign interestingly, is founded by one of the guys that also founded Ripple, one of the most brilliant cryptographers in the blockchain world, a guy named Arthur Brito. And what they're trying to do is create infrastructure that will make more efficient and secure the trading of digital assets so that you can create the kind of broad capital markets that today exist for non-digital assets like equities and bonds and commodities, right? In those markets, there are certain structures that you need to support very, very large institutional trading, large scale trading by institutions. So, those take place at very high volumes and very rapidly. The transactions have to be executed very, very quickly. So you've got to support that kind of trading, but with some very, very basic structures that also ensure, right, that the counterparties and their end customers are protected, that, assets don't get stolen or used in some illegitimate fashion that isn't allowed by a fund manager. So you need custody, you need independent fund administration, you need wholesale clearing and settlement. So PolySign is building all those constituent structures, but for the digital asset world. And that's hugely important, number one, because native crypto assets today already total about $1 trillion in value, and they got as high as $3 trillion when the market was in a bull phase. That's still frankly small compared to what its potential is. Because if you look at the equities world, for example, just US equities alone is 45 trillion, never mind equities in other parts of the world. Imagine a world where all of those equities and all of those fixed income instruments and all of the derivative instruments that play off of those and all the commodities in the world, if all of those things also became digital, they were tokenized. And then you add that to crypto native assets that are originated on blockchains, like the kinds of layer 1 and layer 2 tokens that are in existence already today and growing. That whole mass of value becomes one big digital asset market. You will need, in order to support that market, the kind of infrastructure that PolySign is building.
Absolutely. And it is really exciting, the team that they have and their technology and all the companies interested in working with them. It's looking very successful. Looks like their future is very bright. How about Linqto? How has Linqto been faring through all this?
Knock on wood, but we have been very much of a contrary to market story so far, Linda. And the best way of phrasing this is that, when the market went into a bear market phase in the public equities market, and then within 6 months of that, as we talked about, the private markets followed suit. The sector that was most hurt in technology, both in the public as well as the private markets, in terms of valuation, compression, and share price decline, was fintech, which is the space that we are in, right? Fintech. And then blockchain, which is still mostly a private market play, was also the most impacted. And we've got our toe in that particular pool. And if you want, we can talk about that a little bit in this conversation later on. But the bottom line is that if you're a fintech company and you have some exposure or the other to blockchain, that was like the mother of all storms, and you had been hugely impacted. So when you look at companies in the public markets, for example, like, Robinhood, Coinbase, Forge Global, right? You will see that those companies suffered revenue declines of anywhere between 27% on the low side to 55, 60% on the high side. That was the range of revenue decline, and their share prices declined in like fashion, anywhere from 27, 30% to 60%, 70%, right?
Yeah.
That's huge. In our case, we actually were able to increase our revenues year on year, right, by close to 50%, 50. And we did that without sacrificing profitability. last year. We had, we ran the business with close to 40% EBITDA margins, right? And made revenue of about 37 million and net income of about 9 million off of that. So that in a market that was hugely challenged, we produced just some crazy, contra market results. And I'm proud to say that we've sustained that through the first quarter of this year. We just closed our books on Q1 this year, and we remain profitable and continuing to grow our top line.
Congratulations.
So it's a tribute to the team at Linqto, but it also, I tell you, it is also an indicator, right, that the market that we're addressing is still fundamentally early and therefore continuing to grow, even as the broad market is contracting.
Right.
And what is that market? It's the market for individuals like you and me, regular people, to invest in private market stock.
And we keep hoping that the SEC will change the accredited investor rules so that it makes it more open to a larger group of people rather than just people with specific net worth requirements.
Yeah, I mean, I'm obviously a passionate advocate for that opening up, Linda, and it's more than just being self-serving, because obviously if that were to happen, that would basically remove the single biggest constraint, honestly, to our growth, which is that we can only make our investments available to folks who are accredited investors, which is a financial bar that the SEC imposes. You got to have a certain amount of income and or a certain amount of net worth, and certain is relatively high, right? And that's actually, when you sit back and think about it, does that actually make sense? Because if the whole point of the SEC is we want to protect folks, right, from investments that are, clearly more risky, then it should be based upon somebody's ability or level of sophistication to discern risk and their appetite for it, right? So I had a conversation with Hester Peirce, who's probably the most enlightened member of the commission today. And we talked about this. And I said, Hester, doesn't it make more sense if we were to give people sort of a mini test that ascertain their level of financial sophistication and therefore ability to make investments of this type, plus certain limits, if they didn't have a certain level of net worth or a certain level of income, then you say, okay, you can still invest in this, but you can only invest up to 10% or 20% of your net worth or whatever, right? Wouldn't that make more sense than simply barring folks and preventing them altogether from investing? And her answer was absolutely, that makes complete sense, right? But unfortunately, the other members of the commission don't have that same forward thinking. And so we're kind of stuck.
Yeah. I mean, back in the day when I was working for a big brokerage firm, it was that there were high initial investment requirements and, of course, net worth requirements too at that time. But the reasoning was that it was not a liquid investment for, possibly many years. And that's why they said that they were making the limitations to investors, because you had no way to liquidate your funds. You had no way to cash out. You had no way to get your money back for years. And so it kind of made sense that you had to have more assets or more income in order to be able to sort of endure that whole process. But now Linqto, again, is democratizing finance by wanting to provide liquidity. So now tell us about how you're trying to add liquidity and working with regulators to make a change in the industry.
Thanks for asking that question, because it's actually hugely important, right? One of the big barriers, as you rightly point out, to investing in the private market is that the asset is inherently illiquid. And so you've got this risk that, if the company you've invested in is going to take 3 years to IPO, and after a year and a half, something happens in your life that requires you to get extra cash that you hadn't predicted you'd need, you're sort of stuck, right? We have an approval from the SEC to operate what they call an alternative trading system, or an ATS. I mean, in plain English, what that simply means is that we have the ability on our platform now to allow our members to buy and sell their investments amongst one another. That creates liquidity that in the past was unknown in this market. So if you made an investment in XYZ company with the view that you were going to hold it for X amount of time, and then for whatever reason you decide that you can't live with it that long, you can now offer that on your platform. And we actually did a test launch on PolySign stock yesterday, and we had folks that sold PolySign as well as folks that were buying PolySign.
Okay, so that was the very first transaction of that kind. Exciting.
Yeah, transactions. Yeah. No, I mean, I don't think that it's going to change the basic sort of investment proposition, in the sense that the vast majority of people making private investments are doing that precisely because they want to have that early entry position, right? That allows them to significantly benefit from that future IPO or liquidity event. So they'll continue to hold the stock for the most part. But I can see situations where, one we talked about, you have a personal emergency or something changes in your financial life that requires you to have that liquidity. So that would be one impetus. The other is what I call portfolio reallocation, right? You might decide at a certain point that you want to diversify some of your holdings in a particular stock in order to buy into a new stock that you don't have in your private portfolio. So you can liquefy a portion of that old holding in order to fund your entry into a new holding. That kind of portfolio restructuring or reallocation is something that our trading system will support.
Yeah, and that's a huge change. And for people who aren't as familiar with private equity investing, normally, as you said, the exit is hopefully to have an initial public offering, to go public on the stock market and sell your private shares to in the stock market, and or have those be sold so that yours can appreciate from where you purchased them, or sometimes they're bought out by an acquisition. But if those things don't happen, there really wasn't another way to have liquidity. But now you have this alternative trading system where you're actually able to trade with members and people can liquidate. And I mean, that's really a game changer.
It is. The other use case also is what I call pre-IPO, gains harvest, right? What that simply means is that, let's go back to that example. You invest in stock XYZ thinking you're going to hold it for 3 years. If that company does what it's supposed to do and continues to create value prior to the IPO, what that means is that its stock price is going to be trading up in the private markets even before the IPO. Somebody may want to just realize some or all of that gain before the company goes public, right? They can then sell the stock that they acquired 3 years ago today and just take the capital gain and not wait for the IPO, right? Then, I mean, obviously it's a calculation of, how much are you giving up, but you at least have that possibility, whereas in the past you didn't.
Yeah, and I think that's even more important today because the IPO market's kind of stalled right now. So not many companies are going public, and that's a factor of the market and the market not having fully recovered, the stock market not having fully recovered. And so I think it's a good thing that you've got this other choice now, because we don't know. I mean, what's your opinion, Joe? When do you think the IPO market is going to get a little stronger, and where maybe some of your companies might be able to start talking about going public?
So I was in New York about a month ago, and part of the time I was there was just meeting with a whole bunch of investment banks, trying to get a sense of what the street was thinking about exactly this question. And I think the consensus is that, there's a possibility it may reopen in Q4 of this year. But what is probably much more certain is that next year next year, we'll see the IPO market reopen. On the Linqto portfolio, interestingly enough, right, I would say that there are probably 7 to 10 companies I could point to that are IPO ready, meaning that if the IPO market were to reopen next year, say, those companies will almost certainly be in line to file, go through the process, and do their initial public offering.
Wow, that would be exciting. I could see where that might happen in a very short window.
Yeah, and some of the savvier companies, I mean, I can tell you that there are companies out there like, we don't have exposure to. Klaviyo comes to mind, Instacart is another, maybe Klarna. I gotta imagine they're already talking to their bankers today and trying to get ready for the process in anticipation of either a Q4 or a 2023 reopening of the market, right? I mean, I think the key thing is going to be that I think that if I could point to a single event that could drive that, it would be a clear signal from the Fed that they're taking their foot off the pedal in terms of the interest rate hiking regime, because their key inflation indicators are showing a positive trend downward, right? When that happens, that's going to signal to the markets. You'll probably see a fairly material reaction in the public markets in terms of share prices, and that's going to then provide the impetus for the IPO market starting to reopen.
Well, the bond market is already pricing in lower rates later this year. So we'll see if maybe this May rate hike might be the last one, if they even get to it with, all that's going on in the banking system. We may not even see that hike. It remains to be seen. Goldman Sachs doesn't think that they're going to hike. So it's interesting.
I've never been in a market, just talking about this in my life in the finance industry, that has been as difficult to read as the one that we've been in since the end of 2021. Difficult in the sense that there are so many contrary signals that are in opposition to each other, right? And as a result of that, there's just no clear consensus in either direction. It's just so difficult to read.
Yeah. So I know all the Ripple shareholders are going to want me to ask you this. We've heard that if the lawsuit ends, or when the lawsuit ends, that Ripple would want to go public, possibly pretty soon after that. Do you think that may happen if we got good news? I mean, their lawyers are thinking, they were thinking we could hear something in March. Now it's April. We still haven't heard anything. If we get word sometime April, May, do you think there's a possibility that Ripple could go public?
Yes, although just to, remind everybody, right, you don't go public overnight. There's a process, and that process is typically, 6 months for any company, because it requires a fair amount of documentary preparation. It requires the submission of certain filings to the SEC for review and approval. That has its own timeline. It requires you going before the exchange that you want to list and providing a whole bunch of filings there, going through a review and approval process there. So all that's going to need to happen. It's a ministerial process, but it's a process that nonetheless will take time. So yes, I mean, I think that they would pull the trigger very quickly once they clear the legal hurdle. And then it's just a matter of going through that process to finally get to the public market. But look, the reality was in January of, I think it was 2020, so roughly 11 months before the SEC filed suit, right? Brad Garlinghouse, the CEO of Ripple, had announced to the world that they intended to go public. And, I can imagine that if that suit hadn't been filed, so here's the chain of events, right? That was January of 2020. In March of 2020, the public markets shut down and the IPO market closed because of the pandemic. Remember that? The IPO market didn't start coming back to life until August of that year. And then in September, it was really clearly open. So if Brad had made the decision to pull the trigger, it would have been in that time frame, in that fourth quarter of that year. And I fully believe that if the SEC hadn't filed suit in December of that year, they would have pulled the trigger.
Interesting. And of course, wasn't Coinbase like the last company of yours that went public before all this happened, before the market really turned?
Yeah. And that was a Cinderella story for us, Linda, because Coinbase, when we invested in it, was actually valued less than Ripple. Ripple was at that time in the private market, had just received a valuation of 10 billion. And Coinbase at that time was actually valued even less than Robinhood, believe it or not. It was valued at about, my recollection is it was about in the $4 to $5 billion range in the private market. So we were able to get in at a really low entry point. And the reason for that was because it was a time where the VC community in the private market still hadn't fully bought on to the growth opportunity that blockchain technology represents. So most of the private market investing was being done by a very narrow swathe of VCs, but not the broad VC ecosystem. And that had a depressive impact on the price of Coinbase and also Ripple, right? They were valued less than non-blockchain fintech peers, right? Because, as I said, Robinhood had a much more superior valuation of Coinbase at that time. I mean, today that's not the case in the public markets, right? But that was the case in the private markets. But because of that opportunity to invest in Coinbase at what was a fairly depressed valuation, our investors and we were able to realize a return that was close to 9.5x within an investment period of less than 12 months.
Wow. So a $10,000 investment went up to $95,000.
Yeah.
Wow.
Yeah.
Nice. That's the power of private equity investing, right? You can get in at early prices, much lower prices. And, again, that was sort of like right at the peak of the market where they just had perfection priced in. And not every company can do that. It's just not that part of the cycle, but they just happened to be at that part of the cycle where it was the perfect time to go public. And they really capitalized on that.
Yeah. But think about it, right? And this is the other advantage of investing early, because you're able to get that very, very attractive entry point. Even if our customers, and I don't know, I've not spoken to any of them, stayed long the stock or they after the IPO lockup ended, right? That's what would have driven the 9.5x number I'm talking about. That's based on when the lockup period ended and what the stock price was of Coinbase at that point. But assuming if somebody for whatever reason held it, obviously Coinbase has gotten crushed since then, but they wouldn't have lost money. They'd still be looking at, a 3x gain.
Absolutely.
Right.
And, what we've been through in the markets is very extreme. I mean, and that happens from time to time as an investor. That's what stock markets do. That's when Warren Buffett likes to buy and to be greedy when others are fearful. And like you were saying when we started, this is the perfect time to take advantage of that because prices are much lower than they were. And you have the opportunity to get in below where you could have gotten in a year or two ago. And so the opportunity is even more exciting today that whenever the market does recover, the potential, maybe that much greater. We can't promise, but might be an even greater profit potential than it would have been if we didn't have the dip in the market. So this is a great time for investors to continue to invest and to consider private equity as part of their portfolio, I think.
Yes, no doubt. So at the end of the day, the investment proposition simply is that I can't predict on any given day, right, whether a company stock is going to trade up or trade down. I can, however, predict two things with fairly high degree of certainty because these are conclusions that are based purely on the historical statistics, right? One is that in the long run, that price is going to trade up and not trade down, right? If you're investing in a fundamentally good company, so unless you have a death event where a company basically fails and goes bankrupt, that share price will trend upwards and to the right over time. And the second is that your investment return on that stock is going to be, more than anything else, be driven by your entry price. And the best entry prices are always gotten earlier and not later. Earlier means private, before they become fully valued in the public market. And so our investment proposition is that simple. It's just based on those two things, right?
I love it. I think that's a good place for us to end. Thank you so much, Joe. This was really enlightening. I loved everything you shared with us, and giving us an update on some of your companies was really valuable too.
Thank you, Linda, for the opportunity to share with you and all of your followers some of these insights. I'd encourage them to just, check out the platform, look at the offerings, and reach out to you or to me directly if there's any way we can help answer their questions, educate them, and make them good investors in the private markets. I'd be honored.
Fabulous. Thank you so much.
Great. Thank you, Linda.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.